Welcome back to The Explainer. Okay, so today we're tackling a topic that, let's be real, most of us kind of actively dodge: term insurance. I get it, nobody wakes up super excited to talk about life insurance over their morning coffee, but today we're going to completely demystify this whole thing together. No confusing industry jargon, zero fear-mongering, and absolutely no sales pitches. We're just looking at the pure, straightforward facts so you can actually understand this stuff from the ground up and honestly just make the best possible choices for your family's future.
So I want you to start by picturing something super practical. Just imagine, for a second, what would happen to your family's finances if your income suddenly vanished tomorrow? It is definitely not a fun thought, but it's a completely necessary reality check to ground ourselves in before we start building out your protection plan.
Because think about it, without your monthly paycheck, how does your family handle the day-to-day? Who's covering the grocery runs or the utility bills? What about funding the kids' education, which, let's face it, is only getting more expensive? Are there car loans sitting there? Or maybe a hefty rent or mortgage payment due on the first of the month? Basically, every single long-term financial goal you've built together would instantly be up in the air. This exact reality, protecting the people who rely completely on your income, is exactly why having a financial safety net isn't just a nice-to-have, it's an absolute necessity.
To get you fully prepared, here's our game plan for today. We'll cover the basics of term insurance, figure out your ideal coverage amount and duration, understand how premiums actually work, look at payout options and riders, build out an essential buyer's checklist, and finally go over how to avoid the most common beginner mistakes.
All right, let's kick things off with Section 1, the basics of term insurance.
At its core, term insurance is just a really straightforward life insurance policy. You pay a fixed premium for a specific block of time. Honestly, think of it exactly like a subscription service for financial protection. You pay a small fee every month or year, and if you pass away while this subscription is active, meaning during that specific term, your family receives a massive predetermined payout. If you signed up for a 1 crore policy, they get 1 crore. And in most cases, that's completely tax-free. When the term is over, the coverage just ends. The whole shebang really is that simple.
Now, here is absolutely the most crucial takeaway of this entire concept. Term insurance is primarily a protection product. It is not an investment. If you survive to the end of your policy term, the insurance company just keeps the money you paid in premiums. And you know what? That is exactly how pure protection is supposed to work. You aren't buying this to build wealth, you're not looking for a high return, and you're definitely not trying to get rich off it. You are buying it for absolute, uncompromising peace of mind for your dependents.
Moving right along to Section 2, coverage amount and duration. So, how much coverage do you actually need? A lot of people just kind of guess a random giant number that sounds good, but you really don't have to guess. A fantastic, reliable rule of thumb is to set your coverage at 20 to 25 times your current annual income. So, say you're earning 10 lakhs a year, you should be looking at a coverage amount of roughly 2 to 2.5 crores. Why so high? Well, it ensures your family can safely invest that massive payout in really low-risk instruments and comfortably replace your missing income just by living off the interest. Plus, we absolutely have to factor in inflation. A crore today simply won't buy the same lifestyle 20 years from now. So this 25x multiplier effectively inflation-proofs your family's future.
Okay, what about duration? You've probably seen ads everywhere pushing you to get coverage until you're 99 or 100 years old. But let's look at this logically. Getting a policy until age 65 covers you right through your working years, which is exactly the window when your family actually relies on your income. By the time you hit 65, the kids are probably grown and independent, the heavy debts are paid, and you've got your retirement savings. Now, a policy until age 99? Sure, it covers your whole life, but it drastically jacks up your monthly premiums right now. You generally only need protection until your dependents are financially independent.
And the math on this is honestly mind-blowing. Because an age 65 policy is shorter, your premium is way lower. If you take that exact difference, the extra cash you would have been throwing at that 99-year policy every month, and instead just invest it yourself into a mutual fund earning around 12%, the sources show you could build a corpus of around 1 crore by the time you're 65. That compounding growth literally makes the longer policy a terrible deal for most people. You're usually way better off buying the shorter term and just investing the difference yourself.
All right, let's jump to Section 3, understanding your premiums.
You might be wondering why two people the exact same age can end up paying completely wildly different amounts for the exact same coverage. Well, it's all about risk. Your health and medical history are huge factors. Whether you smoke or use tobacco, that's going to spike your costs big time. Obviously, the coverage amount and term length matter, but so does your job. A miner doing risky physical labor is naturally going to pay more than someone typing on a laptop in an office.
But here's the absolute game changer: your age. The second you buy a policy, your premium freezes for life. Seriously, if you buy at 25, you lock in this incredibly cheap rate that stays exactly the same every single month, even when you're 55 and your health isn't what it used to be.
On to Section 4, payout options and riders.
So, if the worst does happen, how exactly does your family get this money? You generally have three choices here. You can do a lump sum payout, where they get the whole chunk at once. You can do a monthly income, where it's spread out over 10 to 20 years. Or you can do a combo of both. Now, the lump sum payout is highly recommended. By getting the entire amount day one, your family can instantly wipe out major debts, like the mortgage, and then invest whatever's left to earn their own interest on it. If you go with the monthly option, the insurance company essentially gets to hold on to the bulk of the money and keep all that sweet interest for themselves. No thanks.
Okay, now for a really fascinating debate in the insurance space: the return of premium rider. Based on the source data, there are two totally different camps here. Perspective A looks at this as a total must-have. They argue that even though you pay a higher monthly premium, you get every single cent of those premiums back if you survive the term. Feels pretty great, right? Like a win-win. But Perspective B, they call this a mathematical trap. Their point is that if you take a standard, cheaper policy and independently invest that extra premium money yourself, the compound interest over decades is staggering. For example, your investments could generate something like 3.66 crores, and compared to the insurance company just handing you back 92 lakhs with zero interest attached.
Aside from that whole debate, there are some other optional add-ons or riders you can look at. Now, you definitely shouldn't just treat this like an online shopping cart and check every box. That'll skyrocket your cost. But two riders are genuinely really useful because they protect your income while you're still alive. A critical illness rider gives you a lump sum if you're diagnosed with a major sickness, like cancer, which covers your lost income while you're out recovering. Then there's the permanent disability rider. If you become permanently disabled, it completely waives all your future premiums so your policy doesn't lapse. Plus, it provides a payout. Just double check that these specific riders last until your retirement age, usually around 60 to 65.
All right, let's dig into Section 5, the Essential Buyer's Checklist.
Here is your ultimate data-backed checklist for picking a company you can actually trust. First up, the claims settlement ratio. Basically, you want a company that's approving over 99% of the claims they receive. But wait, don't stop there. You absolutely have to look at the amount settlement ratio. See, a company could approve 99 tiny claims but reject one massive multi-core claim, making their basic ratio look amazing. So make sure their amount settlement ratio is over 95%. Next is the solvency ratio. This just means the company has enough cash sitting around to survive a major economic crisis and still pay you. Aim for a score above 1.8. Lastly, check their annual business volume. You want to see something over 5,000 crore. That proves they have the massive scale to stay stable for the next 30 or 40 years.
And finally, Section 6, avoiding common beginner mistakes. We've already talked about the traps of 99-year policies and the big return of premium debate, but the absolute biggest rookie mistake you can make? Hiding your smoking, drinking, or medical history when you apply. Sure, checking the box that says you have a pre-existing condition or that you smoke on the weekends is going to raise your premium today, but lying about it, that literally risks total claim rejection when your family needs that money the most. Insurance companies will investigate a massive claim. If they find out you hid something, the policy is legally void and your family gets nothing. Zero. It's just not worth it.
So how do we actually put all this together? Here is a super simple, actionable roadmap to get your term insurance sorted. Step 1, calculate your specific protection number using that 20 to 25 times income rule. Step 2, run some comparisons using that exact vetting checklist we just went over, and please don't just blindly sort by the cheapest price. Step 3, read the policy details and exclusions. I know it's boring, but do it. Step 4, fill out the application with 100% honesty. And Step 5, get those required medical tests done right away so your policy is officially locked in.
If there is one guiding principle I want you to walk away with today, it's this. Honesty with your insurance company is infinitely more important than hiding facts just to save a few bucks a month. The entire point of this explainer, the whole reason we're even talking about this stuff, is to guarantee your family gets the financial support they need when the worst happens. Complete transparency is the only way to guarantee that security. Which leaves us with one last super important question for you today. Have you actually sat down and calculated exactly how much your family would need to stay afloat?
Honestly, don't leave their future up to chance. Take the blueprint we just built together, crunch your numbers, and take the steps to protect the people you love. Thanks so much for hanging out with me on this explainer, and I'll see you next time.